Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching IndianOpen. Let's go straight to the headlines at this hour. The Reserve Bank of India will conduct a second forex swap auction worth $5 billion on the 23rd of April. The Serious Fraud Investigation Office arrests former IIFL Vice Chairman Hari Sankaran for fraudulent conduct and causing wrongful loss to the company and its creditors. Z promoters sold another 0.8% stake in the company in March this year. Mutual fund industry sources say it may have been to meet short-term obligations. Former Ashok Leyland CEO Vinod Dasari has been appointed as the CEO and whole-time director of Royal Enfield for a period of 5 years. Dasari had quit Ashok Leyland last year to pursue other interests. The Supreme Court will announce its verdict on RBI's February 12th circular on restructuring of debt today. Frankly, that's one of the key monitorables in the session today. But it's a packed show and it's a packed news-heavy day today. Let's take a look at the trade setup for the day. Firstly, global news and interest, surprise, whatever you call it. Aramco is arguably the world's most profitable company, pipping Apple to the post by virtue of the numbers that it declared. I think it made a profit of 111 billion in 2018, which surpasses Apple. So that was newsworthy to my mind. But that aside, what's happened to the world markets is interesting. They continue in their merry ways. So if you just look at what Europe did, extremely strong close. By virtue of all the news flow surrounding trade talks, the data that is coming from China and the US, so extremely strong close for the European markets. The US markets were reasonably decent as well, about 1.5%, and that's percolating down to the Asian screen in today's session, not with the same gusto, but we have a start which is reasonably strong, about 1/3% for most of the key benchmark Asian indices. The Nikkei, which is up about 1/3%, shows that, and the SGX Nifty indicates a start which is marginally in the green as well. So we might have a start which is about 10-15 odd points in the green for the Nifty. The question mark only is, can we build on from there, or will yesterday's pullback bring us further lower? There was some bit of a pullback in yesterday's session for sure. If you just look at what the Nifty Bank did, for example, that was the key driver of the volatility and the pullback in the markets yesterday. So ended about 1/3% lower in trade. For the Nifty, I think yesterday's low of 11644 would be seen as a key support by most market participants, not too far away, about 25 odd points away. If that doesn't break, then most technical experts that we spoke to yesterday, or that I read as well in terms of the evening notes, suggested that that is the key support seen, and until that is broken, the uptrend stays. However, keep in mind that while we're talking about the uptrend, and if everything was so hunky-dory, we wouldn't have the VIX trading so high. The India VIX is still trading at about 1 month high levels. The last time that we saw India VIX trade at 18 levels was on 28th of February. So that continues to still stay near 1 month highs. But flows are okay, about 899 crores of positive fund flows coming in the FIs in the session yesterday. There's a bit of a hiccup, I think, on the day before, which was on Friday, when there was a marginal negative number, but otherwise the FI flows continue to remain positive. What should worry Indian market bulls though would be what's happening to crude, and that has inched up in the session yesterday, and at 61.89 for the US. Crude or Brent would have inched up further as well. We're trading at about 5-month highs for WTI, so that should be a bit of a concern, and maybe that tempers the gains for the Indian markets a little bit in the session today. Let's wait and watch. The bond yields will be interesting to monitor today. They're there for the first time since the borrowing data came out on Friday, so that is something we'll watch out for too. However, what are the key stocks to monitor on a session like this today? Lots of potential movers. So let me qualify that they are potential movers. Firstly, Godrej Properties. They came out with an update post-market hours yesterday, and in their language, this is the best ever quarterly sales performance that they have done. Over 2,900 homes that they sold in Q4. The booking value in excess of 2,100 crore rupees, which is better by 50% compared to what it did in Q3, which was the best quarter until then. So maybe there could be a reaction to Ashok, to Godrej Properties. There could be a reaction to Eicher Motors as well. Very interesting that Vinod Dasari has been appointed the CEO of Royal Enfield for a period of 5 years. The key is Siddharth Lal apparently has said that he's relinquishing his day-to-day duties of Royal Enfield because it needs a new style of functioning. So full line of control to Vinod Dasari. This is important. A bit of a change of guard of sorts at Royal Enfield. Maybe it was going through a bit of a limbo, and Yatin will speak more about it, so I won't dwell too much on it. But this should keep the stock of Eicher Motors interested in the session today. The third one on which I don't quite know what the reaction could be, but this is a very important announcement. Some other things have happened in the past too, but we now get to know today, by virtue of looking at all that's happened in the month of March, that promoters sold about 70 lakh shares, 76 lakh shares. That's about 0.8% stake in the open market. Now, the stock has already been volatile and it's been trading lower. The key is, how does the market view this? Would this mean that other shares could come into the open market for selling as well? Sajid will join in just moments from now to talk about that, so I won't dwell too much on this, but I wouldn't be surprised if Zee Entertainment remains under a bit of pressure today. Let's wait and watch. Last piece, just want to mark something that we've been talking about now. I wrote it in a piece on the website as well, but Nilkan Mishra has put out has given his thoughts on the valuation concerns. He's saying that the fall in the global bond yields has allowed for some re-rating of Indian equities as the yield spread has widened a bit. We, however, note that the yield spread to the US Treasuries remains narrow, implying that Indian equities remain expensive, and the Indian companies at the conference mostly confirmed a growth slowdown. I think the point that he's trying to make is, at a time when companies largely are speaking about a growth slowdown, how is it that the Indian markets are trading at such premium valuations? Well, I do hope some people take note of the valuations as well. Yes, vitamin M, which is the money flow, does take care of the valuations in the near term, but not forever. At 19.5, 20 times, we are not cheap. And I think Q4 will need to deliver, and the commentary need to be very, very positive for these valuation levels to sustain. So it's something that we'll all talk about and monitor. However, let's tell you what's lined up on First Word today. It's the collection of the top editorial stories that we bring to you. The response to the first forex swap auction has prompted the Reserve Bank to announce another one late this month. Ira Duggal will tell us about it. Automakers continue to face a sales slowdown in March. Yatin Mota will join us with the latest figures, and he'll also tell us about what Vinod Dasari has to offer Royal Enfield. Coal India misses production targets for the 13th consecutive year, but by a slight margin. Nikki Mirchandani will speak about that. And then, arguably one of the most important pieces of news, Zee Entertainment. Promoters continue selling in the open market. Sajid Mangat tells us what's changed hands and what's the response been of the lender group which entered into the standstill agreement with the promoters a few months ago. Buoyed by the response to last month's forex swap, the RBI has decided to conduct another one in April. This time, too, it is going to be for $5 billion. Ira Duggal tells us why the central bank may have chosen to conduct such an auction in quick succession. Ira.
Surprise, surprise, within a week of the Reserve Bank of India concluding its first forex swap for liquidity successfully, they've announced another one. We'll talk about the implications or the potential implications of that in a minute, but the news first. The Reserve Bank of India has said that they will infuse another $5 billion in liquidity at the end of April. 23rd of April will be the auction that will be conducted, similar to the previous one. This will be a swap auction where market participants will bid to pay a premium to the Reserve Bank of India, and the Reserve Bank of India will announce a cutoff. Based on that cutoff, they will accept bids. Now, the last auction, which happened just last week, actually was very successful. They managed to get bids of about $16 billion, and then they accepted $5 billion of that and infused about 35,000 crore in liquidity. Now, there is different context to what happened last week in the first auction and what will happen in the second auction. Now, remember, the first auction has come at a time when there were tight liquidity conditions. You were moving into the end of the financial year, so the RBI would have needed to infuse liquidity in any case, because financial year end typically sees tight liquidity, and you'd already done a large amount of open market operations. So there was concern that you were just distorting the bond market by buying out government bonds. So this was a new route to try. Let's do forex swaps. There's enough interest in terms of foreign dollars coming into the country. Swap those dollars for a 3-year tenor and put in rupee liquidity. So that was all in the context of a tight liquidity situation. Now you come to April end. Now, the beginning of the financial year typically sees money flow back in the form of government spending, and you do see easier liquidity conditions. So everyone was more or less anticipating that by the time you get around to May, liquidity conditions will be fairly comfortable. They may not be surplus, they may be neutral to mild deficit. So the question is, why is the RBI choosing to do this particular auction at the end of April? There could be two explanations. One could be linked to elections, because typically the currency leakage, the cash in circulation ahead of elections does pick up, and that has a consequent impact on liquidity in the system. So maybe the RBI is anticipating some of that, and they want to pump in the liquidity that may be required in the lead-in to April, May, when the elections actually peak. Or they could actually be moving their stance into one of slightly easier liquidity. Let me explain that. Remember, we saw a rate cut from the Reserve Bank of India in February. The expectation is that in April you'll see another rate cut, but the RBI has maintained liquidity in a significant amount of deficit, which means that the rate cuts have actually not passed through. Bond yields are flat to slightly higher, and bank rates are actually slightly higher compared to where they were at the time of the rate cut. So there's been a lot of criticism that the RBI is making a mistake that it did in 2015-16, where it went through a rate cutting cycle with tight liquidity, and the end result was that those rate cuts didn't actually transmit into the economy. So maybe the RBI is responsive to that criticism and is starting to move towards an slightly easier liquidity stance. They haven't articulated it yet. Maybe they will articulate it this Thursday when the MPC actually meets. But if you read between the lines, it certainly looks like that tight-fisted approach towards liquidity has eased off to some extent.
Well, and that's interesting. Of course, the story around this would be there on the website. So for all of you who want to understand this, do log on to BloombergQuint.com and try and read up more about this. Sticking to top news, and there's just no good news for automakers. Sales declined across the board for cars, bikes and commercial vehicles as the demand remained muted in March. Yatin Boda standing by with the reported numbers post-market hours yesterday, and also what to make of some of these numbers as well. Tractors, for example, which showed that there was maybe a chink in the armor. Yatin, what have you made of all the numbers that have come out thus far? What stands out?
So Neeraj, yesterday we discussed a couple of numbers, including Maruti, Mahindra & Mahindra, and how really was the tractor segment weak, 31% decline. Of course, the management blamed it on, Rabi crop and the sowing there being weak. But post the market hours, we had Tata Motors, which came out with the monthly numbers. The local sales were close to 68,700 units. That was a decline of 1% year on year. This was largely to do with the fact that the overall commercial vehicle sales on the medium and heavy commercial side declined by nearly 9%, and more importantly, the passenger vehicle segment sales declined by 12%. So it's not only the commercial vehicle segment, but also the passenger vehicle segment which is facing the heat. The company blamed weak consumer demand, the reason for the decline in passenger vehicle sales. Hero MotoCorp and a big negative surprise. We were expecting a 15% decline year on year. The sales have come down nearly 20% year on year at 5.8 lakh units. More importantly, the management does say that given the fact that they have adjusted production, this would probably result into inventory getting cleaned up and becoming leaner. And more importantly, they say that on an overall basis, the March sales volumes, which are lower by 20%, will ensure that the system is slightly better than what it is. Remember, there were a few brokerage reports which said that 80 to 100 is the kind of inventory for certain Hero MotoCorp dealers, and probably this production adjustment and lower wholesale would translate into some inventory getting eased off in the system. Eicher Motors, of course, that will clearly remain under focus. Let's talk about the Royal Enfield sales. They again have surprised on the negative side. Their total sales have come in at 60,831 units. That is a decline of 20%. We were expecting, a single digit or probably a 10% kind of a decline here, but the sales have declined 20% year on year. Both 350cc sub and above 350cc engine capacity motorcycles have seen a decline in overall sales. In fact, if you look at the engine with capacity of 350 and lower, motorcycle sales have slipped by 21%. So clearly the bread and butter business, the routine Royal Enfield sales have been impacted. Key markets probably like Kerala have not yet bounced back as expected. And clearly Vinod Dasari is one silver lining which came as an announcement. he takes over as the CEO of Royal Enfield.
What do you make of that?
Yeah, and that is something we'll watch out for.
So what do you make of that?
So Neeraj, we know that when Ashok Dasari resigned somewhere in November,
Vinod Dasari.
Ashok Leyland shares fell 10%. A lot of brokerage notes came in, next day saying that Vinod Dasari was the one which was in the company for 14-15 years, and he really got things right for Ashok Leyland. He got down debt levels. He improved the operational performance. He not only improved the operational performance but also ensured the trucks that he sells are more profitable. They have done various things when it comes to emission norms under his leadership. And the graph in front of you says that how really the last 5 years have shaped up in terms of the sales CAGR of 16%. And ever since he took as MD and CEO somewhere in FY11, we have seen a steady growth in their overall revenue pattern. Despite all the challenges, they have remained profitable. In fact, if you look at the profit CAGR of the last 5 years, we have seen a very sharp improvement from a level of 335 crores in FY15. The FY18 profits were over 1500 crores. I think 9-month profitability, if I'm not mistaken, is close to 1200 crores. And last 5 year profit CAGR is over 56% under Dasari's leadership. So clearly, this is one guy which has shown capabilities on cost, capabilities on how to really strengthen the balance sheet. Royal Enfield is probably going through a disruption. They also had various operational issues, Neeraj. Margins always were under pressure, but they had faced various labor unrest in Chennai. And the silver lining here is that Vinod Dasari would be based out of Chennai. He takes as a CEO of Royal Enfield. So, Siddhartha Lal, who is the promoter, he steps down from the CEO position of Royal Enfield. He'll probably focus on the parent, the trucks business, probably some design and R&D side. But most of the management team at Royal Enfield will report to Vinod Dasari. He'll be based out of Chennai. And more importantly, the kind of transitions, one is looking at, probably Vinod Dasari would get an edge on the operating side and probably cool the nerves when it comes to the labor unrest, which is, getting repeatedly and big issue at the Chennai plant.
Interesting that there is that change of guard, right? Siddharth Lal, forever known as the guy who is at the helm of Royal Enfield, comes out and says that the line reports to Vinod Dasari. That's that big interesting move. One would reckon that now there would be maybe division of roles, Yatin, that all line function items go on to Vinod Dasari and Siddharth Lal focuses on design because he's anyways moved on to London and tried to do that piece of the business.
So what I understand from his management team, Siddhartha Lal keeps on frequently traveling. He looks at the business strategy. In his note also, he said that he'll be focusing on the overall group strategy, which is not only motorcycles but also trucks and buses. So I think Siddhartha Lal gets more times to dispose, more time to delegate, and probably focus more on design and product. Vinod Dasari, I think, given his background, he's an industry veteran. People swear by him in the commercial vehicle industry. Probably two-wheeler is a business which is new for him, but the auto sector is not a new business for him. Trade unions are not, a new business for him. Dealerships are not a new thing for him. So I think on the operating side, it's something that Royal Enfield will get an edge on. Of course, design or probably product placement. How do you really look at Royal Enfield 650cc or climbing that value chain up? Probably that decision will be promoters or probably a joint decision. But I think Vinod Dasari will clearly be an edge, especially to do with their Chennai operations.
Well, may not be immediate stock reactions, but this could be interesting for Eicher Motors by virtue of what happens to Royal Enfield over the course of the next 1.5 years. Yatin, thanks so much for putting that into perspective. Going through a bit of a disrupted times. Let's see what happens to Eicher in the session today. Coal India is the next stock in focus. It's missed its production targets for the 13th consecutive year, but it's not as bad as it sounds. The target has been missed only by the slightest of margin. The coal miners also shown healthier growth and crossed a small milestone. Nikki Mijitani standing by to tell us how the business has fared in the last financial year. Morning, Nikki.
Morning. It's a slight miss, rather I'd say a narrowest miss that Coal India has reported in a span of 13 years from now, and the mark here is the 600 million ton mark, both in production as well as sales number. But then we'll start off with the production numbers, where the miss, as I just suggested, was the lowest at 606.9 was the actual figure that compares to 610 million ton target. As you can see across the blue and the yellow line, there's barely any difference between the two. Moving on to the growth trajectory of production numbers, that's a strong growth coming in on the production numbers. We're looking at a 7% uptick out there, which compares to the number that we've seen in FY16 when the growth was around 9%. The growth moderated in FY17 and 18. This number, this time around, FY19, comes on the back of strong growth that we've seen for the month of March itself. That's a 10% growth out there on month basis, mainly on account of the recovery and the contribution of its two important fields, that is Mahanadi Coalfield and SECL, which on an aggregate basis contribute to around 50% of Coal India production. On back of that, we're looking at a buoyant growth out there. Let's look at the sales picture. That's a little different than what the production scenario pans out to be. Again, the miss that you've seen is the lowest that we've seen at least since FY08. And if you look at the growth numbers, this time around for FY19, growth has actually slowed down to a number of around 4.8%. If you could move over to the next chart where we have the growth numbers out there. So growth is 4.8%, has moderated from the growth of around 6.8% that we've seen in FY18. Now, two factors go behind this. As I just suggested, that there was a recovery in the two main coal fields, which means that the operational issues through the course of the year weighed down on the offtake margin, on the offtake volumes of the company, and also there were inadequate infrastructural activities which also had some bearing. Having said that, Morgan Stanley report, however, points out that going forward they expect a better growth coming in from Coal India, a growth of around 7% for FY20. Back to you.
Nikki, thanks so much for putting that into perspective. It's not all that bad for Coal India, but can we say that for Zee Entertainment? The promoters have sold a little less than 1% in the company in March. The transactions reflected on the exchanges yesterday. Now, while it's not unusual for promoters to pair some stake in the open market, what's unique here is that they have done this while they have a standstill agreement with mutual fund lenders still in place after defaulting on some repayment schedules. So will the sale impact that agreement? What's the impact? What is it that we're learning from the asset management company sources? Sajid Pankaj Johnson, you talk about all of that. Sajid, good morning.
Good morning.
Why is this so important?
It's important because you have a standstill agreement with lenders to not to sell shares. Either the lenders sell shares or promoters sell the shares. At the same time, you also have rollovers of the existing debt which is there with the lenders. Lenders have given up to September end to the promoter of Zee to bring in equity by sale of 50% of the promoter holding in Zee Entertainment, and that money will be used to pay off the lenders. The amount which we have been talking about. But what has happened is that in the month of February and March, we've seen two of the promoter entities of Zee, Secutor and SL Corporate, selling roughly together, selling nearly 76.3 lakh shares in the market, amounting to 332 crores or so. And the average price for Secutor was 427, while that of SL Corporate was 454. If you look at the current price, 431. So of course it seems that the market knows that the promoters are selling in the market. That's why the stock hasn't moved much in the month of March, if you look at the line graph there. But be that may 25% of Zee's equity is pledged as of now. Promoters hold around 41% in the company, and that means that the lenders are confident that the promoters will be able to pay off, because we've been speaking to mutual fund industry people.
What are they saying? About the standstill agreement.
Yeah, they're saying that the standstill agreement, nearly 90% of the lenders were part of it. So none of the 90 people who belong to the 90% they sell any of the shares.
But the agreement is that neither of the parties will sell, right?
Yeah, so they are saying that these are the shares which promoters may have sold because they have short-term obligations, or the 10% of the lenders or smaller lenders who didn't want to be part of the standstill agreement, and that obligations were coming up in March. So they would have sold for that purpose.
Oh, it gets reported in the promoter's name, but these are pledged shares.
These are not pledged shares. They sold by the promoters to pay off those short-term obligations.
Okay.
So now, if you look at Z Group as a whole, in the last 1 year or so, they have sold nearly 4,000 crores worth of equity in the market. Feb 1st or 2nd was one of the last reporting when we saw 300 odd crores of sales happening. So there is going to be some bit of short-term sales, it seems, till the time all the smaller lenders are sold. I mean, smaller lenders have been paid off, but the larger, bigger lenders, you know, fund houses like Birla or others who have substantial exposure to SL Group as a whole, they are confident that they are not. They are not going to be impacted by it. You know, the larger question which we need to ask here is that, you know, we saw some comfort coming into the share price of SLZ on the basis of standstill agreement, and it recovered from 300 odd levels to going all the way up to 480 or odd. Now it has come back to 431. Now the thing is that the market has sensed that that's a band which is a comfort zone for the lenders, because that's a cover which they have to maintain. So the price will not move in beyond that band unless you have a major event coming up. Z Group was supposed to come up by March end about some kind of deal.
Right.
That hasn't happened, and it's spilled over to the next financial year. They still have 6 months to go for that. But the point here is that there will be always a sense that, you know, if the prices move up and promoters again sell in the market. Yeah. And that's a catch-22 for any mutual fund house. So even though they are putting up a brave face, saying that, oh, we understand that and we are aware of it, or, you know, this was done for the short-term liquidity issues, but the short-term liquidity issues are not going away in the next 6 months. So does it mean that Z Group is going to sell shares at frequent intervals to tide over these short-term liquidity issues?
That's the key question.
That's the key question, because then our lenders are going to lend additional money to Z to ensure that they tide over that.
Yeah.
That's not happening. So they're selling their shares. So 300 crores every second month they're selling, either to meet the short-term liquidity requirement or to pay off smaller lenders.
Okay, interesting. But the big fear that the standstill agreement might be broken and there could be shares that the lenders might sell in the open market because of the agreement being gone. Sajid learns from his mutual fund sources that may not be the case. We don't know as yet, but at least the lenders seem to suggest that is not the case. Sajid, thanks so much for putting that into perspective. That's all that we have on First Word today. We take a slip into a break, discuss, of course, a bit later on the immediate impact on the markets with Amit Khurana of Dolat Capital, discuss what's causing the slowdown in auto sales with Vikram Kirloskar of Toyota Kirloskar Motors, and speak to Amit Jatia of Westlife Development on the demand outlook, expansion plans and more in the consumption space. But after this break, a full tilt towards the day's trade.
Welcome back. You're watching IndianOpen right here on Bloomberg Quint Live. A quick check across Asia right now. A slightly more subdued market, just about 1/3% higher right now for the Nikkei 225. Shanghai is trading up marginally, and so is Hang Seng. For the SGX Nifty, though, it's a slightly more muted performance. Just about a 4-point bump up is what you've got, 11,738. But it's going to be interesting to see how we shape up for trade after making, levels of more than 11,700 on the index yesterday and a new life high for the Sensex. So that's going to be interesting watch. But before that, the more important story that's developed has been the Vijaya Bank and the Dena Bank, which have been merged with Bank of Baroda, creating India's third largest lender rather. And with any such merger comes the fear of job losses. But BOB MD and CEO PS Jayakumar says there won't be any such need to cut jobs. Bloomberg Quint's Vishwanathan Nair spoke to Jayakumar and started off by asking him if the bank will need more funds from the government.
I think we have a reasonable runway to grow. Around third quarter, I think we can go with a market fund rise on the assumptions that we will be able to show continued growth, which would then be saying that notwithstanding the amalgamation, the business is business as usual. And we also hope to show considerable progress with respect to amalgamation. In addition to that, as we go into the following year, the next quarter, next year's gross profitability looks quite good. This year, as of December, we made 13,000 crores of operating profit between the three banks.
Right.
Just simply extrapolating into next year, it probably is between 18 to 20,000 crores.
Okay.
Now, if you assume a lesser level of profit, lesser level of losses on account of non-performing assets, because we move to the recovery cycle, then I think we have a reasonable amount of organic capital coming into the financials in the next year. So I think with a little bit of luck and a lot of work, we can support the growth of our business without dependence on any further government handout.
On paper, these three banks have come together. They're one entity now. But as far as the actual ground level merger goes, that is to say on a branch level, on a systems level, on the processes level, how long do you think it's going to take for Bank of Baroda to become that one large entity?
Now, let me put it to you this way. Starting tomorrow, our customers of, say, the erstwhile Dena Bank would continue to deal with Dena Bank. The customers of erstwhile Bank will continue to deal with Jaya Bank. And it will not be possible, for example, any of these two bank customers to come to Bank of Baroda and access services, because the technology platform in terms of integration does not exist or is getting built up. Come May, there are about 6 to 7 basic services that will be available. These are withdrawal of cash, deposit of cash, balance sheet, balance information, etc. And then the sequence of interoperability keeps increasing every quarter as we have new rollouts. In a 12 to 18 months time, we move to a core banking system, which simply means that we only have one banking platform, and that would effectively truly be able to make everything interoperable.
Okay.
So the process of amalgamation is going to take time, but it's not that everything is happening on a single day. There is going to be progress along the path. That's so far as technology is concerned. As far as operational risk structure is concerned, over the last 4 months, various teams have been working together among the three banks to create the new product programs. And I think as we step in tomorrow, we do have a common product program across all our banks for 90 to 95% of the products. I think that is not a mean achievement in putting it together. And so I think that part of it is done. There's obviously going to be some amount of challenges, because everybody would not be would have not fully been trained, or even if they are trained would not have a recollection, so on and so forth. So we got to give way for some of those challenges, but by and large, we are there as far as product is concerned. As far as people is concerned, I think starting today, the compensation structures are absolutely harmonized. We have put together the people in terms of the general manager level and above. We're now working on the next level of people, and I do think by 1st of July, we would substantially go to a single organization, which is to say that people will report, the managers of employees would not necessarily from the same institutions. So that part of the process will move on. Insofar as branding is concerned, we have a brand which faces the customer today, which is Vijaya Bank, now part of Bank of Baroda, and we'll converge to a single brand as we come closer to interoperability of the two systems. So I think it's a step-by-step process. There's no big bang happening on one day, but every month we'll be making some progress, and we hope in the next 12 to 18 months time we completely complete all the process and truly move to being one institution as seen by the customer.
So the last big merger that happened within the Indian public sector banking space was with respect to SBI and its associate banks, as well as Bharti banks. So at that time, SBI had announced these voluntary retirement schemes for some of the senior employees who may want to look for an exit. Are you introducing something of that nature?
See, voluntary retirement can be introduced for any of two reasons. It can be used because there's excess labor force. It might just be done to rebalance the workforce in terms of getting different set of skill sets of people in place. As of now, I can tell you very clearly there isn't any voluntary retirement program that is available. However, if employees of a bank do not want to join because they technically joined Bank of Baroda, then they have the option to exit, not as a voluntary retirement, but as though they retired in due course. Okay, so that's really what it is. So now what does it bring us here? I think overall there are 2-3 things we must keep in mind. One is that if you were to take our bank and take a bank of our size into other private sector bank, you would find actually the number of employees are more. And the reason for that is there is a lot more people facing the customer side, the sales side of the equation. We relatively have less. So we need to build more people. And then there are a number of other specialized areas in respect of which we need to build talent, whether it is analytics or technology or various other kinds of product structures. So in essence, what I'm saying is that we are likely to be, we will be job creators and not job reducers or destroyers.
So coming next year, you will hire more people?
We will hire, but what is going to happen and what's happening everywhere is that nature and the skill sets are going to change, keeping in view the changed bank times in banking.
That's of course BOB, and we'll of course play out a larger portion of that conversation a bit later on as well. But PS Jayakumar talking to Vishwanath Nair. The key is what to do with some of these PSU banks now that the risk-on mood is on. Yesterday the bank nifty may have slipped a bit, but that could have been an aberration. Will this move largely be restricted to the private sector corporate facing banks, or will some of the other PSU banks also participate? Let's pose that question and more to Mayuresh Joshi, fund manager at Angel Broking, joins us right now on the show. Mayuresh, good morning. Thanks so much for joining in. I'm guessing over the last 30 days we would have spoken about this a number of times, but I think it's a good point to talk about this morning, considering one, of course, the comments from PS Jayakumar, but two, also the fact that the Nifty Bank showed a pause in trade yesterday. Now, my question is for somebody who's looking at the markets and thinking that the banking index seems overbought, but has cash and wants to get a piece of the banking pie because it is only slated to grow higher. What does he or she do? Stick to private sector banks, stick to small size private sector banks because they offer a bigger bang for the buck, or opt for a BOB or a PNB, the likes, where the valuations are a lot more favorable?
Morning, Neeraj. So yes, I think in terms of how the bias might still stack up, the sentiments probably have improved towards the PSU banking lot as a whole. And a large element in terms of how the banking index has probably performed is based on the expectations of asset quality pressures coming off significantly, as we've seen a large part of recognition probably take place, whether it be the private corporate lenders or even the public sector undertakings. The second element obviously is the provisioning element, which has increased significantly, and that itself is emanating some amount of confidence, both in terms of NCLT related cases or otherwise, which probably also gives a very healthy sign in terms of how the balance sheets are stacking up. The third element, specifically in terms of PSU banks, is the capital infusion that the government has taken. A few of the banks have come out of the MCA. And again, I think when you're probably talking about out of the PCA norms, but a large element in terms of what has probably transpired is that there have been a strong traction in terms of recoveries and upgrades for PSU banks. You've probably seen disbursements still struggle a tad bit over the past few quarters, but the large element here is that the undertaking for disbursal or advances growth should improve going forward in the next few quarters. So if you bind all these elements together, you're probably expected to see credit costs come down significantly. Any resolutions that you're probably seeing either through the IBC or the NCLT route, I think that's a huge value addition for the banking sector as a whole as well. And the third element, obviously, in terms of this entire argument will be the valuations as well. So public sector banks, even with the run-up that we've seen, I think valuations still seem to be very, very attractive compared to the private space. But what really happens is the consistency in terms of reported numbers. The MSME exposure still looks a little bit soft. The power sector exposure for corporates which are rated A and below, I think the provisioning there still needs to be done. I think there is an important ruling which is probably expected today, in the coming few weeks. So I think if you understand and try to analyze all these points together, I think private corporate lenders still probably have an upper hand at this point of time. For the PSU banks, I think it's going to be very, very stock specific. So I think the larger name like an SBI is something that we still continue to hold. And the private corporate lenders is something that we still continue to hold. So for a fresh investor, as you put it, I think a staggered way of probably entering these stocks, a few of the select larger private corporate banks, a few of the mid-cap banks, which we probably discuss within the private space, and probably something like an SBI from the large cap names in a staggered way over the next few weeks to probably take care if the markets do turn volatile and also reduce your impact cost.
Nonetheless, can't take away from the fact that the PSU banks have had a decent, in fact, a very good run-up from mid-February lows that it had touched. So the PSU banking index itself has been up closer to 27% since then. So bigger banks obviously contributing to that, like SBI, but it's a decent enough move. Aside from that, just a quick word, Mayuresh, on the auto sales numbers. Clearly, it's going nowhere. I mean, we've seen yesterday numbers coming out from the two-wheeler space, Royal Enfield numbers slipping, Hero MotoCorp's numbers slipping. Not a great show from Tata Motors either. What's the sense that you're getting, and how long could this prolong itself?
So morning, Devina. So I think we've discussed this as well. I think it's going to take a while for the auto numbers to probably normalize. And the street and the market are largely cognizant of that fact. And therefore, you're probably seeing the auto index probably underperform. Again, I think the normal culprits in terms of macro data points, as we would see it, the discretionary spending would still take time to probably improve. What we probably saw in Q3 was a sort of an aberration with higher crude prices, higher insurance costs probably playing truant to how the numbers or the expected demand had probably got deferred. The third element obviously is that you're probably talking about a very high base on a YOY comparison. At the same time, I think with inventory levels building up into the system at this point of time, there are expectations that the discounting factor across variants, whether it's two-wheelers and the subcategories thereof, passenger vehicles, MHCVs, I think should probably be still continuing, which probably puts pressure on the EBITDA margins as well. And the new norms which are expected to come through. So at the ABS, for example, for the two-wheelers, I think the prices are expected to move higher. What kind of an impact that does possibly have is something to be seen. The second half will probably see pre-buying before BS6 norms get rolled out in the next financial year. So to that bit, again, I think what kind of an impact does that have? But pre-buying will also entail that there will be sufficient amount of volume growth. But for the MHCV players as well, I think with new axle load norms coming through, the sales of higher tonnage vehicles, I think what kind of an extent and above that does have for the lower tonnage vehicle sales is to be seen. So yes, I think the pain, as I've time and again discussed, I think might continue for the next few months. It might normalize in the second half, but till that point of time, I think the auto universe might just go through that consolidated phase.
All right, Mayuresh, just stay on with us. Lots more to discuss with you, and we'll touch base upon stocks like Godrej Properties and what's going to come off SIAM, with the possibility that their March quarter could see a little bit of a revenue slip up. But we'll talk about all of these and more with our research team as well. They're standing by to give us more details on whether or not any of these will actually have a bigger stock impact. Mishika joins in on stocks and news. I'm going to talk about SIAM and Godrej Properties, the best quarterly sales recorded in history. So let's start off with Mishika first.
Yeah, so the first stocks, two companies we're talking about is ThyssenKrupp and Tata Reddy. They will sell assets to get approval for an EU merger, reported by a German newspaper. Both the companies have filed a list of assets they're ready to divest in to get approval for the planned European steel activity merger. The companies are also ready to sell packaging steel plants in Belgium and UK to offer customers access to raw steel production, reported by Bloomberg News. Cipla's US arm signs a definitive agreement for investment of $22 million for asset co-development and licensing opportunity for pulmazole drug and Pulmatrix. This agreement is contingent upon Pulmatrix raising additional funds from the market. We also have Welspun Corp. A 100 crore rupees commercial tax order has been set aside by tax authorities. The said order was made in respect of the manufacturing unit of the Gujarat plant.
All right, Mashika, thanks a lot for that. Let's take a look at SIAM. Could expect a slip up in revenues, pushback of a big order?
That's right. Well, there are two aspects here playing out. The first one is, of course, the services business, where the company suggested that because of deferment in certain clients and certain orders from clients, which would include businesses from aerospace and defense as well as communications, the company is likely to see a sequential growth of 1 to 2%. Now, do remember, services contributes to around 82% of, or rather 88% of the overall business, and which is why this becomes very, very critical for the company. And this is against its earlier expectations of around 4 to 5%. Moving on to your design-led manufacturing business as well, the company is looking at a delay of a very large order of around $5 million, and this is largely on account of regulatory clearances that the client is not getting. So the issue is from the client's end. But both these factors taken into consideration, consumption, we're likely to see weakness in growth for the fourth quarter. But margins, on the other hand, as the company has suggested that, well, the outlook here remains intact and there's no change in margins considering both these delays and deferments will be margins neutral. So we could see a little bit of a reaction largely on account of the deferment and delays coming through.
All right, Akam, thanks a lot for that. Godrej Properties had a swell run so far and clocked in the best quarterly sales.
Yeah, that's it. I think for the first time they've done sales worth over 2,000 crores in a particular quarter. So what they've done is 2,900 homes were sold. The total area that was sold was 3.75 million square feet, and booking value was in excess of 2,100 crores. Now, if you see last quarter, they did close to 1,500 crores, so it's almost 50% higher than they did what they did last time around. Last year, same period, they had done 1,000 crores. This time they've done 200 crores to almost 2,100 crores. So the trajectory certainly seems to be on the higher side. What has helped them is the fact that, other part of, they said that 4 new projects as well as existing inventory aided the company. CLSA is extremely positive on Godrej Properties. They're saying they remain in a major consolidated beneficiary and is one of their top picks in the real estate space.
All right, guys, thanks a lot for that. So a lot of those stocks that you need to watch out for. Mayuresh, quickly comment on Godrej Properties. Or the move has been big. It's moved all the way up until 816. It started cooling off over the last few trading sessions. But is this a stock that you would like to own within the real estate pack?
So as a disclaimer, we do own it in our funds, Devina. And again, I think the numbers that they're probably posting are a testimony to the fact in terms of the strong management and the execution thereof. So the sales velocity that you've probably seen in the new projects that they've announced, very few real estate companies have probably announced large scale residential or commercial developments. And they're getting a very, very healthy response for that. The second element also is that with the new accounting changes that have probably happened, the cash flows do bunch up as the revenue recognition starts coming through for projects that hit a certain revenue threshold. The third element is that even in tough times, I think the EBITDA and EBIT margins have held up for this group as a whole. And the kind of leverage that we've seen is quite manageable, even at the current level, and the expectations of what developments can also go through over the next few quarters. So yes, I think I maintain a positive view on the stock, and a disclaimer, I think we do own this stock in our funds.
Well, watch out for Godrej Properties. Certainly could be active in the session today. Extremely strong show put up by the management, by the company in quarter 4. Mayuresh, stay on. So much more to talk about. Time now to dwell a little bit on the technicals. And by the way, the technicals also have some indications of the stocks in news today. But let's get in our experts on board. Hadrien Mendonca with his thoughts on the charts, as well as Amit Harchekar. Gentlemen, both of you, good morning. Thanks for joining in. Amit, let's start off with you today. What's your approach to trade this morning? Nifty or the Nifty Bank? Okay, I think we're not getting through, Amit. Hadrien, can I start off with you? How are you trading the Nifty or the Nifty Bank this morning?
Yeah, hi, good morning, Neeraj. Yes, definitely there, we are observing signs of fatigue in the momentum. No doubt it is not completely died out, but we are seeing patches of, heavyweights losing steam among the banks. Now, if you look at the private banks, the way they are behaving in the past 2 trading sessions, they're clearly showing signs of fatigue and losing steam. So SDFC Bank, ICICI Bank, Axis Bank, IndusInd Bank, the leaders, that led the rally in the overall Bank Nifty, I think they are losing steam. Now, secondly, yesterday was the second consecutive day where we saw a doji. Yesterday's high, was lower than the high of Friday's high. So we are seeing this doji patterns created. So, in the previous week, we had advised to book profits, but, going ahead with keeping this week in, into contention, I think one also can take a brave heart call and go ahead and short the Bank Nifty April futures. We are expecting a target of 30,100 on the downside, and keeping a stop loss at Friday's high of 30,925. That is 10 points higher, keeping a little bit of cushion above the Friday's high.
Amit, if you can hear me now, your call on the index, Nifty or Bank Nifty?
Well, I would be quite cautious on this market at current levels. In fact, we are clearly seeing a lot of sectoral negative divergence happening in this market, where financials hitting an all-time high and you have consumption index forming a bearish triangle. For Nifty, we believe there is a negative divergence also visible on RSI front. But here on this front, we would initiate short positions in Nifty futures only once Nifty futures crosses below 11,700, then the stop loss would be 11,820, and we are expecting 300 to 400 points decline in Nifty. For Bank Nifty, short positions in future would be initiated only if Bank Nifty futures moves below 30,250. Then the stop loss would be at around 30,500, and we can expect a target of around 29,700 to 29,800.
Both our experts have a thought about how the markets could look weak, because both of them are willing to sell an index each. Amit has a sell call on the Nifty futures, Hadrien a sell call on the Nifty Bank. Now, Hadrien, let's start off with your stock ideas. You are, of course, mixing it up, a buy call and a sell call. The interesting bit is that the sell call is on a stock in news, which is Z. Let's start off with that, and then your buy call on Berger Paints.
Yeah, so Z, definitely, yesterday we saw a lot of selling pressure. The first point that we observed is that it surpassed its 50-day moving average, but somehow failed to sustain above the 50-day moving average. So that was one point. Secondly, the rising channel that Z was trading in the past week has been broken after yesterday's move as well, and also closed below the same. So I think going short on a Z could be apt. April futures, we could see a target of 415, keeping a stop loss at 442. The second stock that we're bullish on is Berger Paints. So we are seeing a classic flag pattern breakout. If you check the weekly charts as well, it is on the verge of a larger, falling trend line breakout. So I think Berger Paints should be a good short-term bet. We are expecting target of 340, keeping a stop loss at 336.
Okay, and Amit, your strategies also include mixing it up. You, of course, sticking to index stocks, but you're selling a financial name and buying a metal name.
Yeah, see, if you see the overall movement in SDFC, it has been moving sideways. But if you see the long-term chart, it is forming an ending triangle, and we believe there is a very high possibility that stock could be forming a long-term top. We are expecting a short-term downside towards 1900. Now the stop loss for your short positions on a very from a very limited time frame perspective would be 2015 on a closing basis. Other stock, what we are recommending is buying Vedanta. Here the logic is we are expecting now the dollar index to slide, and that should help even metal stocks to move up. Vedanta was the one stock which had seen a maximum short build-up between the zone of 185 to 190. That has been cleared with very high volumes, and right now we are expecting the stock to spurt towards 205 to 110 in the near term. Now the short-term reversal point would be 182 on a closing basis. So we would be quite positive on metals on expectation that dollar index would slide, and financials are likely to underperform in the near term.
All right. Yesterday, while the auto sales numbers were disappointing, that did not reflect in the prices of some of these automakers. Maruti Suzuki, in fact, ended the day higher by 2.5%, and the big gains came in on a Tata Motors, 7.5% higher. On the charts for both of these counters, I mean, the initial conversation for Maruti revolved around how the stock could actually breathe 6,000 on the downside. It's come back to about 6,800 odd levels. Hadrien, I'll stick to you with this one. For Maruti and a Tata Motors too, post yesterday's move at 187, 188.
Yeah, so Maruti, we saw a very strong bout of short covering in the past two trading sessions. That's the reason we saw that very fast up move. Now all the bad news seems to be already settled in, and that's the reason why we are seeing a reverse trade on Maruti. As we saw the auto sales numbers being released. I think there is another 100-150 point rally still remaining for Maruti on the upside. Its first hurdle is close to the 50-day moving average, that is between the 6,950-7,000 zone. So I think Maruti, we could see another 100-150 points upside, in the short term. As far as Tata Motors is concerned, the stock has been on a tear, and in fact, it has also in yesterday's trade surpassed its 50-day moving average and the 100-day moving average as well in a single day. That is actually showing the strength that we are witnessing. Now, 198 should be that very important resistance that Tata Motor faced in the previous month. Once we see that 198 zone broken pretty convincingly, I think Tata Motors is on its way to rally around another 20 to 25% going forward. So it should be a very good bet, keeping 6 to 8 months in mind as well.
Okay. We spoke about Godrej Properties on the fundamental side with Mayuresh. I just want to get in a quick technical perspective, and I'll come to you, Amit, on Godrej Properties. The stock moved up to 860 odd levels. In yesterday's session, could not manage to hold to those daily highs. In fact, started moving down and closed towards the lows of the day. questioning the confidence of bulls within the stock right now. So how would you look at Godrej Properties? While the news seems to be positive, but it also seems to be like it's already been factored in. How would you play technicals, particularly in Godrej Properties?
Well, I would say that the stock has already given a consolidation breakout above 765. So any decline towards 765, 780 becomes a strong buying area. We don't think that stock has topped out in the near term, because if you see on the upper side, the target of around 905, 910 remains quite intact. We so far have not even seen any negative divergence coming on RSI. That also adds strength to this counter. So we overall remain quite positive as long we do not see a closing below 750. So would recommend buying on decline. 750 should be the stop loss on a closing basis.
Mayuresh, Vinod Dasari taking over at the helm of Eicher Motors. Positive for the stock? Royal Enfield, of course. Positive for Eicher Motors?
So I think you have to probably take it in the sense that Siddharth Lal was a synonym with Eicher Motors for all this while. But again, I think as I would see it, I think Siddharth Lal still is expected to probably run the entire show. I think what kind of changes Vinod Dasari does bring in, because I think the expertise that he probably has is towards the commercial vehicle segment predominantly. But I think there is an urgent need for Eicher Motors, Royal Enfield in particular, to probably ramp up its presence at this point of time. I think the auto universe in general, I think, is facing a slowdown. They've got their two new launches coming through, the Interceptor and the Continental GT. I think what probably happens in terms of brand building around all this, the export component, the spares part of revenue, which is almost 8%, how do they improve all that? I think over a medium to longer term, I think I would see this as something which is of a positive nature. A clear disclaimer, we own the stock in our funds.
Okay, so that's of course Eicher Motors. The other one is Z Entertainment. And Mayuresh, this move by the promoters to sell some stake, lenders that we spoke to on condition of anonymity, of course, said that this doesn't alter the standstill agreement. The market seems to be a bit nervous. The stock was down about 3% yesterday as well. Do you reckon more downside?
That can be a possibility, assuming what has happened. But I think till the lenders are very, very comfortable and with the assumption that something is expected to come through in terms of the stake sale over the next few weeks, I think that is keeping the stock in some amount of a positive terrain expectation. The second element, Neeraj, also is the core numbers. And the core numbers have been pretty reasonable and decent for Z, including the ad revenue growth that you've probably seen, the subscription growth that you've probably seen, and the kind of market share leadership that Z probably has across genres at this point of time, excluding a few of the southern-based areas where the local channels still probably are at the number one position. But the third element obviously also is the kind of investments needed on Z5, the OTT platform, and that might very well continue. So I think if you probably combine all these factors together, there is still some expectations of value at play for Z. Again, a clear disclaimer, we own this stock in our funds.
All right, just about a minute left to go for market pre-open, and it looks like there has been a bit of a pickup on the SGX Nifty. It's going to be an interesting watch because we're also going to keep an eye out on how the currency opens up for trade this morning, because yesterday it was shot 1st of April, so we didn't see a rupee move coming in, and whether or not there is any kind of an implication with regards to the second round of dollar rupee swaps that the RBI has announced that will happen on the 23rd of the month. Whether or not a bearing of that on the currency, we'll have to wait and watch. But Asia as a pack is looking strong, about 1/3% higher, decent gains, 1/3% higher in the Japanese market, and the Nikkei 225 is trading higher by 1/3. China also 1/3%, the Hong Kong trading slightly more muted. Big moves, whether or not we see them coming to some stocks and news like Z on the promoters selling off of that 0.8% equity. We'll wait and watch. Yesterday itself, Z was down about 3% odd. And do we get that much more closer to making new life highs on the index itself? For the Nifty, for the Sensex, obviously we just made that yesterday. So keeping a close eye out on all of those. A few seconds left to go, and I think that's pre-open on your screens. 0.5% higher on the Nifty 50, 11,723. Sensex is up 0.25% as well. Coming to the individual stocks then, Tata Motors once again kickstarts the day in a big way. It's the top gainer and pre-open at least. So that stock's up about 6% odd. Okay, that's cooled off a bit, so slightly more volatile this morning. Tata Motors and ICICI Bank is moved up too. Bajaj Finance trades with gains of about 1.5%. IndusInd Bank, Axis Bank 1.25%. Tech Mahindra, Vedanta, GAIL, SBI, Infosys are some of the bigger movers. Auto as a pocket is not doing a whole lot badly either. Amongst the oil and gas stocks, remember you're going to watch out for some of these names, keeping in mind that Brent crude now is just a stone's throw away from that $70 per barrel mark. So that's making its presence felt across oil marketing companies as well. Eicher Motors 0.5% higher, HCL Tech another 0.5%. More gains than losses, but just quickly run you through some losers as well. And morning session, at least pre-open, shows you an unnatural 10% downtick on Eicher Motors. We'll see how that pans out over the next few minutes of trade. Z is down 4.5%, BPCL down 2.5%, and Adani Ports down 0.5%.
Quick checks on the money markets. They've opened, so bond yields and the currencies will come up on your screen. First day of reaction. Rupee at 69.32, so a bit soft in trade today. Courtesy crude, I would reckon. The bond yield should come up on your screen, and let's see if the borrowing calendar has had some impact. No, nothing too material. Pretty much what Sivakumar said, about a couple of paise higher, so a couple of points higher, so nothing too great on the bond yields either. Just two stocks that I want to quickly mark because the rates will change. One of them is Godrej Properties, the other one is Z Entertainment. Godrej Properties, couple of percentage points higher, Z, and let's see if there is a reaction at all or no, not quite. So let's give these rates a chance to stabilize, and then of course we'll talk more about them. First, get in Samit Sarkar, who joins him the top brokerage calls for the morning. Samit, good morning.
Good morning, Neeraj. On the big brokerage calls for the day, first we have is Macquarie on Endurance Technologies. Now, the brokerage has initiated coverage on the stock with an outperform rating and a target price of 1,400 rupees. Now, it says that the company will be the key beneficiary of safety regulations and premiumization. Along with this, its new customers and rising content per vehicle will also drive the growth outperformance for the company despite a slowdown expected in the two-wheeler sales in India. Now, the brokerage is expecting the company's EPS to grow at a CAGR of around 23% over FY19 to FY21, and it is expecting its return on capital employed to expand to nearly 31% by FY20. And on the back of this strong earnings growth and high return on capital employed, it says that the company deserves a premium valuation. The second note we have is on Persistent System, where Citi has downgraded its rating on the stock to sell from neutral and has cut the target price to 605 from 675. Now, the brokerage has downgraded its rating on Persistent to sell on concerns of sustainable profit growth, and is expecting the company to deliver a slower growth compared to its peers. It also expects the company's margins to be lower than peers due to weak growth, supply side challenges and the rupee appreciation. And on its business, it says that the IP business performance has continued to disappoint so far, and despite an early start in the digital segment, its smaller size is one of the biggest investor concerns, says the brokerage. Lastly, it has cut its EPS estimates for Persistent System by nearly 3% and has lowered the valuation multiple on account of slower digital growth that it is expecting from the company.
Thanks a lot for that, Samit. So some interesting stocks to monitor. I must say the stock that has really been on a roll is Lakshmi Vilas Bank. 10% up in the session today as well. That's 3 days of straight gains. 85 or 86 now, if indeed these rates are the ones that it settles down at. But even if it doesn't, I think it's been a remarkable move. Mayuresh, any thoughts here? Selectively, PSU banks or small size banks on news tended to do well. What about Lakshmi Vilas Bank?
So don't cover that in particular, but yes, I think the smaller size banks have obviously reacted very, very strongly to the market move as well. I think the expectations in terms of their balance sheet size itself and how the loan growth will pan out, plus the expected improvement in asset quality, because a lot of these banks, Neeraj, actually lend to the smaller industries within their specific region. So the MSME lending is quite significant on their part. Yes, RBI has given a leeway in terms of recognition of those assets, but a large element in terms of the lending is probably towards these region-specific industries at this point of time. So I think any slowdown thereof causes huge amount of distress in terms of recognition. And again, I think a few of these banks on the PSU side, I think, which are region-specific as well, also have a huge exposure in terms of the agri advances, in terms of the priority sector lending. So again, I think one really needs to be a little bit more selective at this point of time, because if you properly consider the balance sheet dynamics, the net worth of these banks, the capital adequacy and the asset quality trends, one really needs to take all this into account before one really picks and chooses what he really likes or she likes within the space itself. So I'm adopting a very stock-specific approach within the mid-cap banks at this point of time.
Okay, got that. NTPC up 1.5% yet again. Not bad. The stock has actually made good moves in the recent past. Come off from levels of 105 to 135 now. But remember, there's that big gap that you see there at 150, the hurdle that it generally faces. Mayuresh, NTPC, a sloth in the pack, has really not done much for investors over years now. So since 2016 up until 2018, traded that range, got capped at 150, started making a move off late, but do you see that resistance and hurdle coming back at the 150 mark? And what is the real big game changer here?
No, so you're absolutely right. I think this is one boring stock which probably just moves in a very, very tight or broad range. Again, I think the expectations that probably come through Devina in terms of earnings, I think you're probably talking about capitalization and capex, not just for NTPC, but even for Power Grid for that matter. So I think one really assumes the kind of capitalization to actually exceed their capex. And with that elements in place, you've got your regulated ROEs at 15.5%. So I think it's a very good ROE probably to report for power utilities. But again, I think the expectations on the balance sheet size that they've got, the expectations in terms of the capitalization that is expected to come through, and the ROEs that they probably report is something that the street is probably cognizant about. Now, is there a case for a strong outperformance in terms of exceeding their capitalization or their capex? I think that probably still remains as a very, very limited option for these companies. And to that extent, again, I think the expansion of ROEs significantly probably does not happen on their balance sheets as well. So I think that is the entire premise and the thesis in terms of the earnings expectations for these stocks. So they are those simple, steady compounders, very, very boring stock, but I think that is the way it will be. They'll still probably expect it to remain in a range over the next few quarters.
Okay, Mayuresh, we'll leave it at that. Thanks much for taking the time out and being with us today and giving us that perspective.
Thank you so much.
Well, I must say the stock, which clearly is making its numbers count, is Godrej Properties, up about 6%, 865 and counting. We took a technical view, I think, from Amit Harchekar, if I'm not wrong. Maybe just get in Hadrien Mendonca's view here as well, because that's clearly the poster boy of the morning. Hadrien, 6% higher for Godrej Properties, 865. How much more here? Is it a safe trade or is the best behind?
No, I think there is a lot, more to come for Godrej Properties. Why I am so bullish on it? Because 3 weeks back we saw that very, very large move on Godrej Properties. Now, during that, what has happened is that it has actually broken out from a classic cup and handle pattern breakout. With huge volumes. Now this downfall that we saw in the past 2 weeks, that has actually turned out to be a very healthy thing that has happened. And from here on, again, we are seeing the resumption of trend on the upside. So I think it's a double top around the 910, 915 zone should be your immediate first target, going forward in the coming week or so. That is where I'm expecting Godrej Properties would find the next hurdle going forward.
All right, that's Godrej Properties. Gonna have a strong start, at least that's what pre-open is indicative of. Let's bring in Amit Khurana, Head of Equities and Research at Dolat Capital. He's joining us on the show right now. Amit, good morning to you. How are you positioning yourself? We're about 90 odd points from live highs on the index. Sensex did that yesterday. Is it looking a bit overbought to you, and is that a bit of a concern, the pace at which we've come about? I think we've, for Sensex at least, scaled the last 1,000 points in about 11 trading sessions.
Well, if the intent of your question is it time to book profits? No, that's not been our stance. In fact, what we see is a fair sustenance of this trend going forward, based on the general observations that we have across the sectors, based on the likely news flow that we will get on some of the key sectors, which is primarily BFSI and some of the discretionary sectors. Some pockets do look having overstretched themselves, but I would probably not bother about that too much. I think there is still a fair amount of upside potential left on the mid caps, select mid cap names, and the frontline counters. So to that extent, I would buy the dips as we go along. And very important is the fact that we are looking at a very different environment as we get into the new financial year versus what was the situation 2 quarters back. So I think a part of that optimism is getting discounted, and therefore the kind of flows that we are seeing. And this, we believe, is the key reason for the sustenance of this trend going forward.
Okay, we'll talk about some of these mid-caps as well with Amit and our experts, of course. But minutes out from market open, let's tell you all that you need to know to stay ahead in trade today. First up, Zee Entertainment, where 2 promoter entities have together offloaded 76.5 lakh shares, or 0.8% of the equity, as reported by exchanges on April 1st. The stock likely to start off almost 3% lower.
Next up, there's a new man at the helm of affairs for Royal Enfield. Former Ashok Leyland CEO Vinod Dasari has been appointed the CEO and whole-time director for the two-wheeler maker for a period of 5 years.
Cyient has sounded a growth warning for the fourth quarter, says deferred orders in services business could see sequential growth to fall 1 to 2%. Design-led manufacturing to also result in a delay of $5 million order.
A lot of people are flocking to buy homes made by Godrej Properties. The company has registered its highest ever bookings in quarter 4 with booking value in excess of 2,100 crores.
ThyssenKrupp and Tata Steel will sell assets to get a European Union approval for a proposed merger, reports a German newspaper. Both companies have filed a list of assets they are ready to divest in.
Lastly, among key brokerage calls, Macquarie has initiated coverage on Endurance Technologies with an outperform rating and a price target of 1,400 rupees per share, says it's a beneficiary of safety norms and premiumization.
Okay. Amit, what's the view? What's the house view on Godrej Properties? Would you guys be comfortable, Amit Khurana, buying into a Godrej Properties at the current price after the kind of quarter that they've delivered?
We don't have an official coverage on real estate at this stage, but I subscribe to the general view that you just mentioned. Commercial real estate has been doing well, but very importantly, in the last quarter or so, we have seen a significant level of activity, and if I may put it like bottoming out of the prices for the residential real estate in general. And you also see some of the larger players really cleaning up the balance sheets, which is a good sign. And Godrej Properties, of course, their portfolio is markedly much better on quality and the ownership structures and the delivery schedules. So to that extent, the fact that they are getting good response is not a surprise to me. But I see in general, residential real estate is probably the one to look out for the medium term, and some interesting names will crop up.
Quickly, your view on the change at the helm for Royal Enfield with Vinod Dasari taking over?
Well, I mean, given his track record at the previous organization, obviously it's a very, very positive step. But the challenges will not be few for him. The company faces a significant challenge in terms of the demand slowdown, and also in terms of the big initiative that they are putting up to make their presence felt at the global scale. It also helps the promoter team to focus on strategic issues far better. So overall, a very, very positive decision, I would say, with a seasoned person now as the head of affairs and strengthening the overall breadth of the management team.
Okay. Quickly, top calls then. We've got about 50 seconds left to go for market opening from both our technical experts. Amit, Harchekar, first to you.
Well, I would be selling TCS on a rally. The stop loss would be 2060, and we're expecting TCS to move lower towards 1950.
Hadrien?
I'll go with the buy Infosys target of 770, keeping a stop loss at 745. The main reason is a clear inverse head and shoulder breakout on Infosys.
Interesting. Okay. Jaiman, stay on. We'll just take in opening thoughts from you post market open as well. But we are slated to start off marginally higher. That's not bad. Let's wait and watch. The question only is that can we build on from there, or would yesterday's pullback in the Nifty Bank come back to haunt us? Our experts believe it's a good time to sell the Nifty and the Nifty Bank futures. But here's how we're starting off. Marginally higher, as we said, about 0.25%. The Nifty Bank stable right now, but let's wait and watch. Too early to call it right now. The mid caps and the small caps will come up on your screen. They were doing okay. At least the mid cap index did reasonably okay yesterday. For now, about 0.25%. So no great shakes. Just about in line with what the benchmark indices are doing. Maybe slightly higher, but not a bad start for our markets. Not as strong as what the US markets did, but nevertheless in the green. And that's the overwhelming color of green. The only ones which are losing out are oil marketing companies because of what's happening to crude, I presume, and Z Entertainment a couple of percentage points lower. This is, of course, after the 3% cut that we saw yesterday already. So arguably, Z Entertainment remains the top draw on the losing side. On the gaining side, Eicher Motors, a strong reaction to Vinod Dasari being at the helm of Royal Enfield, so that one has done okay. ONGC does reasonably okay. Coal India, not a bad set of numbers coming in, missing the year-end estimates only marginally. Maybe that's why the street is okay. And Infosys, I think something that Hadrien referred to, clear head and shoulder pattern. Maybe the IT companies will have a decent day. Let's see, they're starting off okay right now. Maruti too in the green, by the way. Yesterday was in the green as well. So auto's not doing all that bad. Trading, the index is trading at 3-year lows, so maybe finding some support at those levels. Very quickly, a couple of pockets that I want to highlight before I hand it over to Devina for what's happening across the broader end of the spectrum. Firstly, as we said, the stocks in news, the key movers and oil impacted companies would be in focus. So while I spoke about HPCL out there, that one is the top loser. The upstream companies are not having a bad day. So Oil India and ONGC, at least ONGC starts off higher. So good start to that one. And then stocks which were trading at new highs until yesterday. Let's see how they've started off today. Well, Varun Beverage is about 1.5% higher, so that one is doing okay, but not so much for Adani Gas, about 0.5% lower. And Solara Active, which had a 7% spike in trade yesterday, starts off on a muted note. But let's see, these stocks are around new highs. Let's see if they manage to do well in the session today as well. Devina, what are you spotting?
Well, aside from the ones that you mentioned, which is Lakshmi Vilas Bank, 10%, Godrej Properties, another 6%, you're seeing some interest coming about in some of the smaller IT names as well. So First Source Solutions is up about 3.5%, Hexaware is up 2.5%, then you've got gains coming into the likes of Religare, 2% higher, and EIH moves up 2% higher as well. Reliance Infra, you've got a Brigade in price which is up. NMDC moves up in today's session. MOIL 2 is up. So PSU stocks are not doing all that badly. Within the real estate pocket, it's not just Godrej Properties, while Godrej Properties has having the larger share of the move today. Nobura Realty is not doing all that badly too. Should pull up a prestigious Stasis up 1%, and even a Soba for that matter, a smaller name which is not probably pitched in as much in this recent up move in the real estate pocket. Today's session is up marginally about 0.33%. Jubilant Life is up 1%. Tata Elxsi again from the mid-tier IT pocket is up 1%. And the Dilip Buildcon moves up 1% too. So last 7 days really not had a good time. Prior to that, 3 months, the stock's been up about 50-odd%. That's what you've got in the terms of the market breadth. It's slightly better off. 663 stocks advancing on the NSE versus 473 stocks which have moved lower this morning.
But you know, Devina, the interesting thing is that the two big newsmakers are the ones that are reacting the most on the Nifty. Eicher Motors on the gaining side, and clearly the market seems to be liking the fact that, you know, Dasari, it's a reputed name going to Royal Enfield. So maybe an initial reaction, we don't quite know that. But Z is the interesting one. Lenders told Sajid that the standstill agreement stays. But 3% yesterday, 3% today.
And they've been gradually and steadily in smaller quantities
selling,
exiting. So that too raises questions.
I know, I was asked this question today by Amit, that why is it that, you know, suddenly today this is big news, because they have sold some stakes in the month of February as well. But a large chunk being reported, and I think the market taking cognizance of that. It's something that doesn't sit quite well. But I must say that the lenders that we spoke to suggested that they have done this for meeting some short-term obligations. It in no way changes what the long-term commitment of the promoters or the lenders who have entered into the agreement is. So that's something that you got to take on board. The selling from the large 90% of the lenders may not necessarily come into the market.
It's an interesting play because, you know, you wonder till what time they're ready to just hold on to you know, what they've got.
I think the timeline is September, right?
Yeah, I mean, they're supposed to find a buyer. It's not happening. It's getting pushed back.
Yeah.
And in that period of time, if the stock price starts to take a knock, what happens? I mean,
well, $1 million question. Let's see. For now, that stock is down 3% and Eicher Motors is up 3%. Hadrien, Mendonca, quick opening thoughts on the index if you have one. The Nifty Bank, by the way, started off a couple of percentage, not a couple of percentage points, 0.2% lower. Maybe that, or maybe a word on Eicher Motors, which is up about 3.7%.
Yeah, so for the Bank Nifty, nothing has changed dramatically after the opening. I think I would continue to remain cautious and go ahead and even short the Bank Nifty, expecting a target of 30,100 and stop loss should be strictly at 30,925.
Okay. That's on the Nifty Bank. Some other movers. In yesterday's session, actually, telecom as a pocket did not do a whole lot badly. In fact, I think the telecom index was up almost 1%. Bharti Airtel in today's session is up 1.7%, 346. Amit, Harchekar, would you take a call on Bharti? Would you take a trade here at 346?
Well, I would be buying Bharti on any decline towards the 325, 330. Good thing is now the stock is back about 200 DMA. Good consolidation at around 325, 330 zone. So in the near term, we are expecting stock to test a 375, 380 zone. This is a bear market pullback. It's not a bull market recovery. So that would be the area from where I would turn quite cautious. So till then, it's a good buy on any decline.
Amit, Khurana, and this is for you. Just highlight for us in your recent study and research that you have been doing with regards to what kind of companies that one invests in. The conversations that we've had revolved around companies having higher ROCs to the tune of about stable around the region of 15 to 20%. Is that a parameter that you watch out for, aside from the fact that the earnings need to be more stable as well?
Well, of course, I mean, those are the basics of whatever work we do around sectors and stocks. But, based on the conversations that we've had in Q4 and especially towards the closing side of the quarter, there were 2 or 3 key observations that we came across. One was that there is a marked slowdown in the volume growth for staple companies, and that's been our stance, that they will tend to underperform. It seems to be the case, and we would probably look out for some more underperformance from these names. Against that, we saw some significant moves being done by consumer discretionary companies, especially on the durable side. The Q3 was impacted because of the rupee depreciation and a very muted pickup in demand. Now Q4 is not showing a very major uptick in demand, but the price corrections by the companies in terms of mitigating their raw material costs, in terms of making sure that their inventory gets pushed, seems to be in the work. Now western and the southern regions have started showing some inquiry levels. North, of course, had an extended winter, and therefore it may take a longer time for the durable companies to put out their inventory. So our general take has been that durables is something that we are backing up for the next couple of quarters. We see that the valuations are fairly attractive, and versus staples, durables has been our preferred space. Overall, we like banks throughout. So while we were backing up private sector banks, but we believe that over the next quarter or so, a couple of quarters, you will see some very interesting plays out emerging from the public sector banks also. Now, while we are limiting ourselves to only the top 2 names here, SBI and PNB in particular, we've seen the integration of BOB with the other 2 banks going through. Now they're operating as a single entity. So over the next couple of quarters, market will watch out as to what sort of synergies come out and what sort of growth they are able to showcase. So overall, our take is that while the rally has made a fair amount of gain, there are still pockets which will emerge, and they are currently available for investors to look at with a slightly medium-term profile. And those are the names that we are essentially looking to advise our clients on.
By the way, SIAM has started off 6% lower, 610 and counting. I don't think the street is in any mood to reward a company which, even if it's sanguine on the longer term, is sounding near-term concerns. Amit, Khurana, does your IT team have coverage on SIAM, and what did you make of this announcement?
Well, no, we don't cover SIAM, so I won't be able to comment on that.
No, that's completely fine. I'll come back to you, Amit, on Eicher Motors and the auto pack as well. But since the stock is down about 6.5%, quick thoughts out here. Hadrien, Mendonca, it's not necessarily the most liquid of the IT names, but strong dip today, the top loser on the Nifty 500. Any thoughts here?
Yes, SIAM, has continued to remain weak in the past 2.5 weeks, and we've observed that every low is lower than its previous low. So I think the structure is also slightly changing, and I think this weakness would persist going forward. So I think one cannot rule out the levels of 600 as well going forward for SIAM. So it would continue to remain weak.
Continue to remain weak. I think important monitorable. Every low is lower than the previous low, so do watch out for signs as well. Amit, Khurana, come to you on the change of guard at Eicher Motors, and the market seems to be rewarding that stock. It's the change of guard at Royal Enfield, but 3.5% uptick for Eicher, and then Maruti is the other one, which the numbers were largely in line with what the street was working with. The reason I bring these two stocks up is whether they provide a good risk reward. Leaders of their categories, temporary slowdowns, we don't know if it's temporary or no, but slowdown certainly. Is all of that in the price for both of these?
Well, I would say to a fair degree, but let us look at it in the context. These are the bellwether stocks. These have been the bellwether stocks for a long time, and Maruti had some stupendous performance for the last so many years. So was the case with Eicher, and at a certain stage, market was building in too much of optimism, to the extreme side, and really rewarding them fairly, rich multiples. In some cases, quite, shall I say, ridiculous multiples. Now that cycle has, started going the other way around. Now, valuations per se now look comfortable, but can they go cheaper? They may not look like that because you are not sure about the earnings visibility. I must make a clear confession here. I thought the March numbers would be relatively better off. They haven't come as relatively better as what we were expecting. So to that extent, there is an element of skepticism that is prevailing in our minds also, and we'll have to see how the next quarter or so looks like. But will the stocks probably show a fresh downside risk? May not be. But will they underperform the markets? I can fairly say that over the next quarter or two, they still have a risk of relative underperformance versus the benchmarks. So therefore, it's a slightly tricky call to make. But from the franchise part, I mean, no doubt both the companies retain their very strong franchise, good brand recall, their ability to come out with strong innovative products, that remains intact. So one will have to slightly take a longer term view, and at a certain price you make a leap of faith and then start building in overweight positions. But I guess that's not the time right now. It's better to wait and watch as to how the next few quarters work out for.
All right. Let's talk a little bit more about Titan. The stock right now at 1123 has been going from strength to strength. We had the management coming on board a few days ago and talking about their jewelry business and how well it's likely to perform. Didn't really give us any color on what the margins could be like, but the anticipation was closer to about 15% for the company. Jewelry business, remember, contributes closer to 80% in the overall scheme of revenues for it. So that picking up is definitely a big kicker for Titan. However, on the stock, Hadrien, Titan, would this warrant a trade?
Yeah, so Titan currently is actually entered into consolidation phase, and it's a 50 rupee range that it is stuck into those. So the higher end is at 1150 and the lower end is at 1100, 1110 levels. So I think unless and until either of these levels break, the direction would be very difficult to call out for. But in my opinion, I think the previous primary trend is a solid up move, and I think once we see the 1150 mark broken convincingly, I think that would really advocate a long trade over there. So I would go long only if we see the 1150 level on a Titan broken on the upside.
The other one would be a Bata. The stock has been on a stellar move in the last 1 year or so. It's made a new 52-week high. The stock's at 1384 now, going from strength to strength, 83% in the last 12 months on the stock. No signs of giving up, no signs of strains coming in within the stock price as well. Amit, Harchekar on a Bata at 1384, does it look a bit steep and a bit overbought?
Absolutely. On the short-term chart, the stock is into an overbought zone. Plus, we are seeing a continuous negative divergence in RSI. So, would we be buying the stock only when it comes towards 1345, 1350 zone? Now, stop loss would be at around 1320 on a closing basis. If that gets violated, then it would be a trend change confirmation. Till then, the larger trend remains on the upside.
Okay. Amit, Khurana, while you may not have coverage on Signed, what's the view on mid-cap IT? Are you sanguine? What are the ones that you're watching out for from perspective of earnings this quarter?
Well, earnings, I guess, will have a slight negative tone to it, because obviously the currency depreciation is one element, but we've also seen some concerns emerging on the likely volume trajectory that you will get to see. But overall, our stance on IT has been more on the neutral side. We were overweight. We reduced our positions as the rupee started appreciating, and of course, we were finding better opportunities on a valuation parameter and risk parameter on the other sectors. So our sense is that you will have a risk of relative muted performance. I'm not calling it underperformance now, because a lot of stocks have actually corrected, and given time corrections, of course. So they may have a relative muted performance versus the benchmark indices, at least for the next quarter or so. And then as the trajectory gets built up, the visibility gets built up, one will take a fresh look at these names. There have been some mixed conversations that we have had with the IT vendors of late. Some are sounding reasonably bullish, and while others are sounding cautious. So we're also sort of playing it by close, in the sense that we're playing it very tactical, and therefore we'll wait and watch.
Okay, Amit, Khurana, Amit, Harchekar, Hadrien, Mendonca, gentlemen, all of you, thank you so much for taking the time out and being with us today and giving us your thoughts. Really appreciate your time. The market's completely flat. The Nifty Bank 2, which was at a point of time down about 0.4%, is now about 55 odd points lower. So nothing too dramatic, just a soft start that we're having for the Indian markets in the session today. Take a break, but discuss what's the key topical point, which is autos, and what's causing the slowdown in auto sales. Vikram Kirloskar or Toyota Kirloskar Motors joins us on the other side to talk about that. And then we speak to Amit Jatia of Westlife Development on demand outlook, expansion plans, and more within the consumption space. Back with Indian Open right here on Bloomberg Queen. Flat day for the Indian markets, but the auto index at a 3-year low. It's going through a rough patch. Sales have been slowing down for the last few months for the auto companies, and the question marks remain about what could happen in the times to come. I think it's important to get a perspective from one of the auto vendors as to what the outlook in the near term and the medium term looks like. Mr. Vikram Kirloskar joins in right now to talk about that, because Toyota seems to have bucked the trend a little bit. Mr. Kirloskar, good having you. Thanks so much for joining in and giving us your time. What's your sense, firstly from an industry captain's perspective, are these trying times likely to linger for a while, or is it difficult to say, or would you believe that these will get done in some time? Because I remember conversations with auto companies in the month of December. Then the outlook was that once the NBFC problems settle down, auto sales, CV sales will all come back to normalcy. That isn't quite happening.
Yeah, auto sales have been tough this year. It started off very well at the beginning of the year. Growth was fantastic. It started tapering off in the second half. I don't know what the reasons are, but we've been trying to analyze, in our company at least. We've had some growth last year. 7% is what we have said for the whole financial year in terms of volume. It could have been better. The last few months were not as good. Like I said, we started the year earlier. But I was trying to analyze what all is happening in the market. Is this only from finance? Is it only from retail finance issues, or what is it? It doesn't seem to be because of any retail finance issues. There seems to be enough finance available for the kind of vehicles that Toyota Kirloskar at least sells. We are generally in the higher end vehicles. The Fortuner I know as a higher price vehicle. But one interesting statistic my marketing and sales guys were saying is that the time required for a service, that is time from service 1 to service 2, it depends on number of kilometers which has been driven, has actually increased. So at least in our market, our customers seem to be driving less. Now this could be due to some very good things. It could be due to the metros taking off. I've seen the metro ridership in Bangalore has been increasing substantially. It could be due to shared mobility. If it's because of these two things, I think it's good for the country. It's good for the environment. But it's going to be I think a tough struggle this year as well. If we get 6-7% growth this year, I think I'll be very lucky.
Wow. Mr. Kirloskar, so if it is due, and I'm guessing we still haven't reached a conclusion as to what the reasons could be, but if both those reasons that you spoke about are due to play, and I mean, you know what's happening in Bombay with the public transport system. I mean, a lot of metro projects are on as well. That would point to arguably a lower sales regime lasting for the next few years. It may start maybe after 6 months, after 1 year, we don't know that. But it could last for a reasonably long period of time if indeed those are the reasons.
No, I'm not sure. You know, if you look at around the world, just shared mobility or metros or better public transport hasn't really reduced sale of cars that much. It has reduced emissions, definitely. Okay, it has reduced perhaps overcrowding of roads. But, you know, we are still, if you look at the number of cars per population, we are amongst the world's lowest. So there's a lot of headroom potential. There's a lot of headroom potential in smaller towns, in the developing urban areas. If I look at least around Bangalore, I see the road infrastructure. Yes, we are tight. We talk of traffic jams in Bangalore, but Bangalore is adding 10, 12, 15 million square feet of prime office space a year. And people are moving around. The metro is improving. This is a good thing. I believe the way the highway projects are going on, you do require mobility to get the economy going. You know, it's mobility delivers a growing economy, and a growing economy requires mobility. I think it's a chicken and egg situation, but I think both the chicken and egg will hatch at the same time in the years to come.
Right. Mr. Kirloskar, good morning to you. You know, I just want to take it forward from where my colleague left it. While we're talking about the sales not picking up and this being slightly more trying times for the entire auto space, the Auto Dealers Association has also commented on with regards to the overall inventory pile-up that we're seeing, 50 to 60 days now for passenger vehicles. Is that a growing concern? Because, you know, once this stock doesn't start moving in a meaningful way from dealers, new fresh orders, wholesale orders will actually not translate into much.
You know, our company doesn't believe in having stock with dealers. So our stock with dealers are very low. We reduce production the moment we start seeing any slowdown. So we have very limited stock in the dealers, in the pipeline, or even in our yards in the factory. So we tend to produce as per requirement. So I don't have a stock problem in my company.
Did you recently reduce production?
So we've always worked this way. We always work like this. So we don't do it. We just literally every day we monitor the way the demand is coming in, and we keep adjusting our output.
No. So did you recently reduce production, sir? And is, you know, keeping in mind the market?
It will happen on a daily basis.
Okay.
It doesn't happen on a monthly or a quarterly basis.
Okay, but just to give us a color on the fact that, you know, the industry itself, not from your perspective, while you do it on a daily basis, from an industry standpoint, I mean, there are delays. We've been talking about NBFCs and the loans that have been pushed out in the auto segment, which have actually caused a little bit of a delay in taking those purchase decisions from customers, to the fact that there has been high inventory, to the fact that even though manufacturers and dealers are pushing out those big discounts, still the sales are not picking up. So, I mean, while you can't put a finger to
December
it.
was one of great months in terms of volume and the worst month in terms of discounts. I think people got really good deals. And I think perhaps also in March there were a lot of discounts. You know, this whole discounting thing, you know, building up stock and discounting is not a good practice, very frankly. And I think as the industry matures and things get more competitive, people will find in the long run it's better to produce as per demand and keep lower level of stocks across the country.
Is there a threat to this discounting and this competition which is there in the industry turning into something which is pretty detrimental to most manufacturers in terms of their costing and pricing, because the raw material costs are not going anywhere.
I think the manufacturing companies are very mature. They understand exactly what they're doing. It's the cost of keeping an older product with you and giving it to a customer. I think everyone looks at the benefit and cost benefit of it and takes the right decision. I don't think the industry is so immature to harm itself by discounts.
Mr. Kirloskar, what's happened to the demand from fleet operators? That was one big driver for mid-size cars. You have a product like Etios as well, which caters to that market.
Yes.
What's happening there?
Yeah, fleet has been one of our strong points in the last 1 year. We've had good demand from fleets. I think as the shared mobility pans out across the country, I still think that is a growing market. It's a good market.
Okay. A couple of industry-wide questions. Firstly, this FAME 2 discount, if I'm not wrong, which was where the policy has been changed, that from earlier being given to individual car owners, I believe now is being given to fleet owners. Does that change how the industry approaches this whole move towards electric vehicles?
See, our Toyota Kirloskar's approach towards electric vehicle was primarily focusing on hybrids. Okay. A strong hybrid like the Camry we produce can run, the car runs by itself without the engine running as well, or with the engine running. It does an optimization, and we believe from a well-to-wheel point of view, that is from the source of energy to the end use of energy, it is one of the most efficient forms of transportation. Also, it's one of the most efficient forms of transportation in terms of carbon emission. So our policy is to continue strongly on developing and bringing out new hybrid models in the future. We have shown some electric vehicles, but it depends a lot on the infrastructure, charging infrastructure, how it develops. And based on that, we will add the electric vehicles to our portfolio. FAME 2, as compared to FAME 1, and regarding Toyota Kirloskar, we used to get a benefit of an incentive on the Camry. That is not there anymore. So we are getting basically no incentives on any of our vehicles. Our present hybrids are beyond the price limit in FAME 2.
Mr. Kirloskar, just to carry forward, just want your opinion on whether or not the industry right now seems to be wanting more of new launches, more product offerings, and a different mix of sorts. And where exactly is the most amount of traction in which segment, even in passenger vehicles? Because that probably tells you a consumer's mindset, whether or not the entry-level cars are getting more traction, mid-sized cars, as you said, and what is the mindset driving the kind of demand growth for those various segments?
Typically in the past, what I had seen, and I don't know if it holds good now, but many years ago I did some study, and I found that the more expensive cars would sell better when the stock market goes up, and the lower priced cars would sell better when the interest rates came down. I think it still somewhat holds good. I think a healthy economy will keep this market going. But let me say some positive things about the auto industry. We've talked about maybe this year's demand. This is 1 in 5 years or 4 years that it has been a tough year. And this is a cyclic industry like any other industry. Some years will be fantastic. We're used to those fantastic years. So we see a slightly dampening of demand. People start worrying. I don't think anyone should worry. We have one of the most competitive industries in the world. Car industries in the world. There are more products in the B sector in India, giving the consumer a fantastic choice and a fantastic price and quality. We are one of the most competitive producers in the world, one of the largest exporters of B segment cars in the world, more than 800,000. It's more than China or anywhere else. Our auto component industry has become top class, largest amount of Deming Prize winners. So I think we have a very positive and a very, a glorious future going forward.
Interesting. Well, one certainly hopes for that to happen. If I can just wrap up this interaction.
It's going to be very competitive. Listen.
Sorry, yeah.
Glorious future means the customer is going to get a damn good deal. Okay? He's going to get a better vehicle at a good price. He's going to get a safer vehicle, lower emission vehicle at a great price.
Well, as a customer, I can tell you I'm not complaining. As a customer, I can tell you I'm not complaining. Just one last thing. I heard you mention at the start of the interaction, Mr. Kirloskar, that you mentioned that you will be lucky if you clock in a 7% growth this year. Would you reckon that the industry growth rate would be lower than that?
I know, let the elections get over. I think the country has a lot of positives going for it. The tax collections are going up. The infrastructure construction is going up. The economy is going to do well. There's nothing pessimistic in the future for me.
Okay, so you believe that the economic growth post-elections will pick up?
The period is going to eat up 2-3 months of the financial year. So if I look at a 12-month period, maybe it's a tough year. It's going to, the economy will grow. There's no reason why anything should go wrong.
Okay, but industry growth rate could be slightly lower than your growth rate, I reckon.
Well, over a 12-month period.
Over a 12-month
I'm sure it's going to pick up after the elections.
Okay. Well, we'll leave it on that note.
As a new government comes in and people get confidence and when there's a stable government in place, it'll certainly pick up.
Fair call. Would have loved to chat more, but out of time completely, Mr. Kirloskar. Thanks so much for taking the time out, though, and joining us. Lovely chatting with you.
Thank you. Bye.
All right, that's one word from the auto industry. Take a break. Coming up next, a chat with Amit Jatia of Westlife Development on demand outlook, expansion plans, and more.
Hello and welcome. This is Bloomberg Quint. We are in conversation with Amit Jatia, the Vice Chairman of Westlife Development, to take stock of how the company has done and what we can expect as we move into the summer season with respect to discretionary demand as well as the company's plans in terms of expansion. Mr. Jatia, thank you for joining us and taking the time out speaking to us on Bloomberg Quint. Let me begin by asking you about gearing up for the summer, because I'm sure a lot of product ranges will perhaps need some tweaking in order to, I suppose, garner in the requirements from customers. How is Westlife Development preparing for the season?
Actually, from a new product development and particularly sort of dealing with what's going to happen in the summer, we've been quite ahead of schedule. I'm happy to say that a couple of days ago we launched the new platforms, both for value, where we have a very attractive price point for the consumer, where they can choose different burgers and different drink options at tremendous value. Additionally, we've launched our new extra value meals, where when you buy a meal you get a French fry free, which is a premium branded McDonald's product. And additionally, we've launched 3 different new products in McCafe. And, consumers are absolutely loving it. And over the last 3 or 4 years, the work we've done on building platforms, on menu innovation, quarter on quarter has been really appreciated by consumers, which, of course, fortunately are reflecting in our results.
All right, Mr. Jatia, then can we talk a little more about the outlook going forward? Westlife Development has seen some very robust same-store sales growth over the last 4 or 5 odd quarters. The real question is, to a certain extent, are we expecting some base to catch up? And this I juxtapose against the kind of demand that you are seeing when it comes to discretionary spending. How are you expecting some of these aspects to work out?
Sure. First and foremost, you got to understand the context of same-store sales growth. At least from a Westlife point of view, this is our 14th quarter of same-store positive sales growth. So the quarter that ended in December is effectively 3rd or 4th year of positive growth. Now, same-store sales growth is really a compounding effect, and therefore it's not about the percentage of same-store sales growth. I think the important thing is that when you go in the 4th year or the 5th year, comping against the old quarter, the important thing is first to retain the customers who you have accumulated over the 4 quarters and then grow on top of that. So let's assume last year, we did say, I'm just making the number up, we did 25% comps or same-store sales growth in say a specific quarter. And the quarter before that, in the previous year, 10% and say 5% or 8% before that. The important thing is the minute you comp even positively or grow same-store sales positively, you've not only retained such a big base, but on top of that, you've added even more customers to that. So we have defined our vision 2022 quite clearly, and we did that in 2016 when things were really difficult, in fact. And we boldly laid out a plan which is sort of pretty much on track for us. So we've said that sustainable same-store sales growth is normally between 7 to 9%. And therefore, year on year, that's the number that we are quite confident of delivering. I feel that even though, of course, the economy has its ups and downs, it impacts consumer spending and sentiment. And after the last difficult period, 13, 14, 15, we decided that, whether things are good or bad, the category is growing quite nicely, and it's a young category. Therefore, we internally have taken a challenge to ensure that at least we keep same-store sales growth positive. So I'm quite hopeful that as the business develops over the next 2 to 3 years, our vision 2022, 7 to 9% same-store sales growth looks a reality to me, basically.
You did speak about, a platform that you guys have introduced right now. The last time we had a conversation, you guys also spoke about a rice platform which was launched. Can you tell us a little more about the response and the kind of traction it is getting right now?
Sure. So, I'll just differentiate between a promotion and a platform. A platform is something that sort of gives you results for 5 years, 10 years. And of course, it takes a couple of years to establish a new platform, because just because, say, a company launches a platform doesn't mean the consumers will adopt that from day one. Firstly, rice has worked out really well for us. It's now pretty much a standard menu item across all our restaurants. We will continue to build on different flavors of rice as we go along, and we will normally bring back rice on television in the future, because it takes us to remind consumers a few times before the platform starts settling in. So we are quite pleased that it's a new option that now consumers have, and especially it makes McDonald's a meal destination as well. Similarly, value platform, we were the ones who created this platform in 2004. And the Happy Price menu, in fact, lasted almost for 8 to 10 years, which we finally replaced with the McSaver menu. And the McSaver menu came about, I think, 2 years ago, and we've constantly evolved that. What I'm really excited about is that the most recent evolution, and that's why it's, of course, a platform, because you keep evolving that as well, is essentially bringing a price point to the consumer. And if you look at, say, a cappuccino, and McDonald's McCafe has done really, really well, and now we have over 180 McCafes across our territory. But a cappuccino typically starts at 99 rupees. But today you have the option of choosing cappuccino as one of the beverage options, along with a burger or a product, and getting the same for 85 or 89 rupees. So the point is, now that's value. And you will see from Westlife and from McDonald's that we always look at sustainable platforms. The idea is not for it to be a promotion where one time we give this offer and then we have to take it away. So I feel, therefore, this 85, 89 rupee platform that we've created, along with the new extra value meals, where a French fry, and that too a McDonald's French fry, is now free as a part of the meal. I feel that this just sets a new benchmark for value, and I think it should work quite well for us in the next 3 to 4 months.
Okay, only for the benefit of our viewers, I'd like to reiterate the company's Vision 2022, where they are looking to set up around 400 to 500 stores. That's McDonald's, looking at around 300 to 350 McCafes, as well as 300 to 325 odd McDelivery hubs. And they're also targeting about EBITDA margins of around 13 to 15%, along with the support of around 79% with respect to same-store sales growth. Mr. Jatia, I assume you're on track in all these numbers. Any updates with respect to the same?
Yes, I mean, we did an investor day in June of 2018, where we did a check on what we had presented in 2016, and we do believe that we are on track to deliver our Vision 2022. Like I said, it's never about a quarter on quarter when you're building a platform and when you're going for high growth. But year on year, we've definitely been pretty much trending towards our Vision 2022. So we are quite confident of delivering on 2022.
All right, Mr. Jatia, then let me just, zoom out a little and talk a little more about consumption in general. There are a lot of, I would say consumption companies out there which are suggesting there's a little bit of a slowdown after tremendous 1.5 years. The real question comes down to the fact that some of these companies are actually questioning whether or not there could be just some amount of subdued movement. Now, let's leave the rural aspect aside. If we only talk about urban areas, in your observation, do you think demand in general is up to the mark in line with what you're used to or what you have seen over the past 1.5 years?
Obviously we've just sort of completed the last quarter, and therefore it's very hard for me to really talk about it, as it will become like a forward-looking conversation. However, all I can say is that quarter on quarter is not the way I at least like to judge a business. Sometimes, things work out, sometimes things are a little slower, but net, at least from our point of view, we are confident of delivering a 7 to 9% same-store sales growth, which obviously means that through the consumer journey, through the ups and downs of the industry, we need to be able to find enough consumer sweet spots that at least keep them bringing back to McDonald's restaurants. So while I'm sorry I might not be able to give you specifics on the last 1.5 months, but I can say that on a trend basis, we are at least quite confident about delivering on our vision of the 7 to 9% same-store sales growth.
Right, Mr. Jatia, my question actually wasn't to do with this particular quarter specifically, or perhaps the last few quarters. I just wanted to better understand if there is a little bit of a change with respect to consumer sentiment as a whole, with respect to the industry as a whole, perhaps not specific to Westlife Development. Do you see any problems in terms of consumption? That was what I was trying to understand better.
No, that's what I meant. I get the question,
right,
and I get it that it's sort of beyond. It's more an industry aspect, and therefore, but I finally sort of leads back down to a bit of a forward-looking question.
Okay.
My view is that yes, when you have seen 20-25% same-store sales growth or almost 30% top-line growth, I don't think that one can expect the same trend to continue every year. I do believe that to that extent, if you were to compare, it's not going to be, I feel, possible to sort of maintain that trajectory. But I definitely feel that through the ups and downs, a sustainable number is yet deliverable. But yes, consumer sentiments do shift a little bit. And to that extent, yes, there is a slight change from what it was in the previous quarters.